What if the global financial system has already broken and we're just waiting for the official announcement? Right now, behind closed doors, the Federal Reserve is activating an emergency protocol. This hasn't been seen since the 2008 collapse. They aren't just worried about a recession. They are terrified of what happens when the markets open this Monday. Today, we're exposing the secret liquidity injection and why the next 48 hours could permanently change your bank account. The world of high finance operates on a schedule most of us never see. A hidden calendar where pivotal decisions are made while the public is distracted. While you are enjoying your weekend, spending time with family, or catching up on sleep, the most powerful bankers on the planet are locked in windowless rooms in Washington and New York. This isn't a conspiracy theory. It is the standard operating procedure for a systemic crisis. History shows us that the biggest financial bombs are always dropped on a Sunday night, just hours before the Asian markets open. Think back to the collapse of Lehman Brothers in September 2008, or the forced sale of Credit Suisse just recently. These events didn't happen during the Tuesday lunch rush. They happened in the dark, under the cover of the weekend, to prevent a global bank run and to give authorities time to coordinate the narrative before the first trading bell rings in Tokyo. Right now, the indicators are flashing a violent shade of red. We are seeing unprecedented movements in the overnight repo markets, and a sudden unexplained surge in the Federal Reserve's discount window borrowing. This is a tool banks only use when they are desperate. This suggests that a major institution, or perhaps several, is facing a catastrophic liquidity shortage that could trigger a domino effect. The Fed is currently preparing what they call an emergency protocol. This is a set of tools designed to flood the system with cash to stop the gears of global commerce from grinding to a halt. But here's the problem. Every time they use these tools, the value of the dollars in your pocket shrinks. We are standing at a crossroads where the choice is either a total market meltdown or a hyperinflationary rescue package. In this video, we are going to break down exactly what is happening behind the scenes this weekend, the secret mechanisms being triggered, and what you need to do before the opening bell on Monday morning. To understand why the Fed is panicking right now, we have to look at the plumbing of the financial system. Most people think of the economy as stock charts or retail sales, but the real economy runs on liquidity. Liquidity is the oil that keeps the engine running. When liquidity dries up, the engine seizes. No amount of horsepower can save it. Imagine a massive skyscraper built on a foundation of sand. For years, the Fed has been pumping water into that sand to keep it firm and stable. But now, the water is draining out at an alarming rate. We are seeing a liquidity trap. This happens when banks are so terrified of the future that they refuse to lend to each other. Even if they have the cash sitting in their vaults, they hoard their reserves, because they don't know which of their peers is about to go bankrupt next. This is exactly what happened in 2008 when the interbank lending market froze, nearly ending Western civilization as we know it. The Fed is preparing to step in before Monday. They have detected a massive blockage in this vital interbank lending market. If banks stop lending to each other for even 24 hours, the entire global payment system fails. Your credit card stops working at the grocery store because the transaction cannot be cleared. Businesses can't make payroll because the short-term credit lines they rely on have vanished. The supply chain, which is already fragile from years of disruption, completely snaps. The Fed's emergency protocol involves something called the standing repo facility. This allows the Fed to act as the lender of last resort on a massive scale, bypassing the traditional banking system, to keep the lights on. However, the sheer volume of cash they are preparing to inject suggests the hole is larger than they are admitting publicly. We are talking about trillions of dollars in shadow banking liabilities that are suddenly coming due. When the Fed steps in this weekend, they aren't just helping banks. They are trying to prevent a total societal blackout. The scale of this intervention is a clear signal that the underlying economy is far weaker than the official jobs reports and GDP numbers suggest. They are fighting a fire that has already burned through the first floor, and they are desperate to keep it from reaching the roof. For decades, professional investors and massive hedge funds have used a very simple, almost foolproof strategy. Borrow money in Japan at near-zero interest rates and invest that money in higher-yielding assets elsewhere, like U.S. tech stocks, high-yield corporate bonds, or even emerging market debt. It was considered free money, a literal printing press for the elite. But recently, the Bank of Japan did the unthinkable. They raised interest rates and signaled more to come. This caused the value of the yen to spike. Suddenly, all those investors who borrowed yen had to pay back much more than they bargained for. This triggered a massive margin call heard around the world. To cover their losses in Japan, these funds had to sell their most liquid and profitable assets in the US, namely, the Magnificent Seven tech stocks. This is why we saw the Nasdaq and the S&P 500 take a massive hit recently. But the selling hasn't finished. There are still trillions of dollars tied up in this carry trade. As the yen continues to strengthen, the pressure to sell US assets becomes unbearable. The Federal Reserve knows that if this unwinding continues into Monday morning without intervention, it could trigger a feedback loop of selling that wipes out years of market gains in a single session. This is the contagion effect. It starts in Tokyo at 8 p.m. Eastern, moves to London at 3 a.m., and hits New York by 9:30 a.m. The Fed is currently in emergency talks with the Bank of Japan and the European Central Bank to coordinate a massive currency swap. They are trying to artificially stabilize the yen and provide enough dollar liquidity so that these hedge funds don't have to dump their US stocks all at once. If they fail to coordinate this before the Asian markets open on Monday, we could see a limit down day, where trading is halted because the prices are falling too fast. This is the nightmare scenario the Fed is trying to avoid. They are essentially trying to catch a falling knife that is the size of a skyscraper, hoping they don't get cut in the process. While the headlines focus on the stock market and the price of Nvidia or Apple, the real action is happening in the repo market. The repo market is where banks and hedge funds trade high-quality collateral, like treasury bonds, for overnight cash. It is the heartbeat of the financial world, processing trillions of dollars every single day. Usually this market functions perfectly in the background, invisible to the average person. But when it breaks, everything breaks. We saw a terrifying preview of this in September 2019, when repo rates suddenly spiked from 2% to 10% in a matter of hours. The Fed had to jump in with hundreds of billions of dollars to save the system from a total freeze. Today the situation is even more dire. The Fed has been shrinking its balance sheet through a process called quantitative tightening, or QT. They have been sucking liquidity out of the system to fight the inflation they helped create. But they have sucked out too much. The banking system is now parched, gasping for air. We are seeing signs that the plumbing is backed up again. Large regional banks are reporting that their excess reserves are hitting dangerously low levels. When reserves get too low, banks stop lending, and the interest rates in the repo market start to skyrocket. If the Fed doesn't announce a pause or a reversal of QT before Monday, the repo market could seize up entirely. This would mean that even the most stable companies in the world wouldn't be able to get the short-term loans they need to pay their suppliers. The Fed's emergency protocol likely includes a secret facility to provide unlimited cash to the repo market, effectively restarting the money printer under a different name. They won't call it quantitative easing, because that would be an admission of failure in their war on inflation. Instead, they will use technical jargon like liquidity support or collateralized lending. But don't be fooled. It is a bailout of the entire financial structure, funded by the future purchasing power of your currency. They are choosing to save the banks at the expense of the dollar's value, a trade-off they make every single time. Why is Monday morning so significant? In the world of finance, time is the enemy during a crisis. Over the weekend, there is no price discovery. No one knows exactly what anything is worth because the exchanges are closed. This creates a vacuum of fear, and fear grows in the dark. When the markets open on Monday, all the pent-up anxiety, the bad news, and the margin calls are released in the first few minutes. If the Fed hasn't released a statement or taken action by then, the market will assume the worst. They will assume the Fed is behind the curve and has lost control. This leads to a panic selling frenzy. The Fed knows that they have a window of about 48 hours to craft a narrative and a policy response that calms the nerves. They are looking at the dark pools and the Sunday night futures markets with intense scrutiny. If the S&P 500 futures are down 3 or 4% on Sunday night, the Fed will be forced to act before the New York Open. In March 2020, at the start of the pandemic, the Fed held an emergency meeting on a Sunday and slashed interest rates to zero. They didn't wait for Monday morning because they knew Monday morning would be too late. We are in a similar situation now. The economic data from rising unemployment to cooling manufacturing is telling a worrying story. They are worried that the soft landing they promised has turned into a nosedive. By stepping in before Monday, they hope to create a floor for the markets. But every time they do this, they create more moral hazard. They teach markets that the Fed will always bail them out. This weekend, the stakes are higher than ever because the Fed's credibility is at an all-time low. If they step in and the markets still fall, then the last line of defense has failed, and we enter uncharted territory. So, what does all of this mean for you, the average person who isn't trading millions of dollars in the repo market? It means the rules of the game are changing again, and not in your favor. When the Fed activates these emergency protocols, they are essentially devaluing the currency. Every dollar they create out of thin air to stabilize a bank or a market is a dollar that makes your savings worth less. We have seen this movie before. The massive stimulus of 2020 led to the highest inflation in 40 years. If the Fed pivots now and starts a new round of liquidity injections to save the markets this Monday, you can expect inflation to stay higher for much longer. Your bank account might show the same number, but that number will buy fewer groceries, less gas, and less housing. Furthermore, there is the risk of bail-in procedures. While the Fed is trying to prevent bank failures, new laws passed after 2008 allow banks to use depositor funds to stay afloat. If they face a solvency crisis, while your deposits are insured by the FDIC up to $250,000, a systemic crisis could strain the FDIC's own resources, which are only a fraction of total deposits. This is why we are seeing a massive move into hard assets like gold, silver, and even Bitcoin. People are losing faith in the ability of central banks to manage the system without destroying the currency. If the Fed steps in this weekend, it is a signal that the system is too fragile to stand on its own. You need to ask yourself, do you want to be entirely dependent on a system that requires an emergency rescue every few years just to keep functioning? This is the time to look at your asset allocation. Are you overexposed to the stock market? Do you have enough cash on hand in case of a temporary banking holiday or technical glitch? These are the questions the elites are asking themselves right now, and you should be doing the same. Protecting your purchasing power is no longer optional. It is a necessity. We cannot ignore the geopolitical context of this emergency. The US dollar's status as the world's reserve currency is under attack like never before. The BRICS nations Brazil, Russia, India, China, and South Africa are actively working on alternatives to the dollar-based SWIFT system. They are watching the Fed's every move, looking for signs of weakness. When the Fed is forced into these emergency protocols, it sends a message that the US financial system is unstable and reliant on constant money printing. This accelerates the trend of de-dollarization. If the Fed has to print trillions more to save the markets, foreign central banks will likely continue to dump their US Treasury holdings in favor of gold. This creates a vicious cycle. The Fed has to print more money to buy the treasuries that foreigners don't want, which leads to more inflation, which leads to more de-dollarization. We are seeing a shift in the global balance of power. For 80 years, the US has been able to export its inflation because everyone needed dollars to buy oil and trade. But that era is ending. The emergency protocol being activated isn't just about saving a few banks in New York. It's about maintaining the dominance of the US dollar. If the Fed loses control of the bond market, the US government's ability to fund its massive debt disappears. This is why the stakes are so high. This isn't just a market correction. It's a battle for the future of the global financial order. The decisions made in the next 48 hours will determine if the dollar remains the king of currencies, or if we are entering a new multipolar world. The Fed is fighting a war on two fronts: domestic economic collapse and global irrelevance. And they are running out of ammunition. There is a psychological concept in the markets known as the fade put. It is the belief that the Federal Reserve will always step in to save the stock market if it falls too far. This belief has driven investors to take massive risks, knowing they have a safety net. But what happens when the safety net is rotten? By intervening this weekend, the Fed is reinforcing this dangerous behavior. They are essentially telling the world that failure is not allowed for the big players, only for the small ones. This creates a zombie economy where inefficient companies and reckless hedge funds are kept alive by artificial liquidity. Over time, this weakens the entire economic structure. The emergency protocol being activated now is a short-term fix for a long-term structural problem. We have reached a point where the debt is so high that interest rates cannot be raised enough to kill inflation. Conversely, they cannot be lowered enough to stimulate growth without causing hyperinflation. The Fed is trapped in a box of its own making. This Monday, they might succeed in propping up the market for another week or another month. But they are doing so by sacrificing the long-term stability of the nation. The Fed put is becoming more expensive every time it is exercised. Eventually, the cost will be the total loss of confidence in the currency itself. When that happens, no emergency protocol in the world will be able to fix it. We are watching the slow-motion collapse of a financial paradigm that has existed since 1971. The events of this weekend are just the latest chapter in that story. The question isn't if the system will change, but how much of your wealth will survive the transition. The next 48 hours are perhaps the most critical we have seen in years. Whether the Fed makes a public announcement or works quietly behind the scenes to flood the repo markets, the reality is that the financial system is under extreme duress. The emergency protocols being prepared right now are a testament to the fragility of our debt-based economy. As we head toward Monday morning, the best thing you can do is stay informed and stay calm. Don't make emotional decisions based on a single day's market movement, but do take a hard look at your long-term financial security. The world is changing, and the old strategies of set it and forget it may no longer work in an era of constant central bank intervention. We will be monitoring the situation closely and providing updates as soon as new information breaks. If you found this deep dive helpful, please subscribe to the channel and hit the notification bell so you don't miss our emergency update on Monday. What do you think? Is the Fed doing the right thing by stepping in? Or should they let the markets crash and clear out the debt once and for all? Let us know your thoughts in the comments below. We read every single one and value your perspective. For more on how to protect your wealth and navigate these uncertain times, check out our next video on the screen right now. Stay safe, stay vigilant, and we will see you in the next one.